Phew, okay, well, today was a brutal day in the stock market. The good news I have, and pretty much the only good news I have, is that the percentage of stocks trading above their 50-day moving averages finally got to the official oversold level. I call this AT50 for above the 50. I am Dr. Duru with Ahan Analytics, bringing you the market breadth. Okay, let's do a quick snapshot. Hopefully, if you're watching this video, you're well aware of what's causing all of the extreme angst. This headline here on Yahoo Finance says it all. This is the brutality of the day. I mean, this has been the worst thing we've seen in about 5 years. So there's a lot of people who aren't used to seeing or feeling severe market pain. There are a lot of interesting headlines in here. I hope to get to some of these articles later today or tonight. But the one that really caught my eye is this one down here. Retail traders step in to buy as others flee in tariff rout. This is something I wish I could get. This is a dynamic I wish I could get good data on because everywhere I turn, the advice is consistent for retail traders and investors. Do not panic. That's something I also say. This is all noise. Over the long term, you'll be just fine. And the advice to retail traders is constantly just buy the dip, buy the dip, buy the dip. And of course, now things are so extreme, you should extremely buy the dip, right? And this advice has worked, and that's why it's issued out almost automatically. But I'm just a little bit wary when I see just about everybody on YouTube and everybody on social media. And when I say everybody, this is really anecdotal. These are just the accounts that I like to follow to keep tabs on what are some of the biggest followed personalities saying to their audience. So when I say everybody, I'm talking about really a small group. I'm not doing a full-time analysis. I wish I could. But consistently, I see the advice is the same from all of these folks, which is stick to the plan, buy quality companies, and all of that good stuff. So what have wanted to write about during times like these is who is selling. If all of this great wisdom is telling people to hold on and to deploy cash into severely discounted names, then who is selling? One account I follow said, well, it's the algos, and it's market makers who are manipulating things. But still, somebody's buying and selling, even if it's a robot selling, they're selling on behalf of some real person. So anyway, that's just going to be a mystery. We all know for our sake, for us in the retail space, that this time-honored wisdom is good. But still, I'm just a little bit more wary. I just can't help it. I'm a contrarian. It seems kind of weird to be a contrarian when the market is in this extreme, but the contrarian in my way deep in the back of my head is saying, hold on a second. Let's keep examining evidence for why this time could be different. And actually, in my last blog post, and I'll show it here really quickly, I called it "Time for a Tariff Crash Trading Plan." I did lay out sort of a case for why we should stay alert for how this could be different. And the main headline here is if indeed the global economic order is being significantly restructured, then we have to consider that this time is different. And when I say different, I don't mean that, suddenly the stock market is just going to crash in like the depression or something. What I really mean is this chart here that I put in my blog post, which is recognizing that the stock market does go through long extended periods where it essentially goes nowhere. And it's very possible that we are at the beginning of a nowhere zone, and during this time, the market and financial markets will be churning and digesting all of the implications for all the massive changes that are happening. And then, of course, because things are happening so quickly, we could get up one morning and the US flips the switch, and suddenly we're going to snap back to the previous global economic order. But all indications are, and this is, just taking our officials at their word, all indications are is that they are very serious about restructuring this global order. So if you find people who are overly optimistic about what's to come, if they're still talking about, oh, this is just a negotiating tactic, if you hear those kinds of things, just, put it for duly noted, but just keep an eye out that serious changes could be afoot, and we need to be prepared and brace for them and be flexible. Okay, so that's my overall headline. That's the context in which we are now going to turn to my traditional market breadth trading rules for market extremes. So that's what 122 started all about, is how to negotiate around market extremes. We are finally in a market extreme with the percent of stocks trading above their 50-day moving average, finally hitting the 20% oversold level. If you're curious about why and how I came up with 20%, you can go back to the blog and click on that market breadth link. So now that we're oversold, let's also look at the percentage of stocks trading above their 200-day moving average, which is I call AT200. It's now down to 28.5%, and let's see how bad that is. And yes, indeed, look, we are now filling in this gap and coming down to the lows we saw in 2023. In previous blog posts, I have proposed that if we get to a true market extreme, this indicator may actually be ready to test the 2022 lows. So this is something to keep in mind for overall downside risk. So now let's go. Now that we know that the market is officially oversold, let's go to the VIX, because that's another part of my AT50 trading rules, which is I want to buy when the market is both oversold and volatility has spiked. And sure enough, it spiked big time, 39.5%. It's actually at a new high over all the previous peaks going back to last summer. So now this is the tricky part. I don't really want to anticipate how high the VIX can go, given it's now gone above the previous two spikes, and it has this this spike from August, of course, went all the way up to 60, almost 66%. If we're dealing with a world now where the VIX can travel between 30 and 66%, then I don't want to be too cute and try to time a top here. So instead, what's better in my book to do is just to wait for a plunge. I've talked about this before. Wait until there's some sort of volatility implosion, as you saw here, as you see here, and as you see here. The last volatility implosion actually was not so sharp. And so I was a little slow in recognizing it, but it did steadily march downward. So this is what we're looking for, something that essentially what I call breaks the fever of the fear. And usually there's two things to note in these dynamics. It's very the market to sustain fear. It takes a lot of energy. And this is why you see the VIX will spike, but then come right back down. And then once fear gets exhausted, it doesn't come back very quickly unless we are truly, truly in a dire situation. And we're not there at this moment. So these are the dynamics to watch out for. In my previous blog and video post, I mentioned this as the key test. I wanted to see whether the VIX would stop here and come back. It stopped here for a little while, came back a little bit. I did a little nibble on shorting the volatility index with just one put option on VXX, and it was actually worked well until close to the end of the day. So that's probably going to be toast. But anyway, that was just my first nibble at close to oversold conditions. Now let's go to the indices, and then I'm going to wrap it up. There's so many individual stocks I could go through, given the carnage that we could be here all night looking at the car crashes and rubbernecking the car crashes. So here we are, S&P 500, the what I'm now calling the bear market's first area of agitation is now broken clean with today's massive 4.8% loss, massive gap down. Notice how it gapped right at the bottom of this area of agitation that I drew. Also remember that I consider a bear market where as soon as an index or even an individual stock gets below its 200-day moving average. Another thing to notice is now the 50-day moving average is fast converging on top of the 200-day moving average. So whenever we do get a rally, there is going to be very stiff resistance at this level again. That's what I'm anticipating, not predicting. Okay, so how far did the S&P 500 get down? Well, it passed this September low, and now it's back to where it traded in mid-August, which is important to note because, as we know, now the VIX is working its way higher up to the highs of August. So now there's some synchronicity that's going on there. How low can the S&P 500 go? Well, if we're just looking at support levels, let's say the August lows, right? That's just on pure technicals. I think that's a little bit of a stretch just because we're already oversold. It will take a while to get to this level under more normal extremes. I know that kind of sounds like an oxymoron, but what I expect is that if we are going to test the August low, it's not going to be straight down from here. We'll have a rebound from oversold conditions and then a heavier sell-off. That's one scenario. And then if we get that low, then notice that the conventional definition of a bear market is still quite a ways away. So that tells you that there is significant downside that's possible in bad to worst case scenarios. The NASDAQ is still much worse off than the S&P 500. I was surprised. I should have drawn this line a while ago, but I was surprised to see that, oh my goodness, the NASDAQ is only 400 points away from the conventional definition of a bear market, which happens to be just above the level now where the NASDAQ had its former all-time high back in 2021. All this means that unless the new economic order is completely throwing big cap tech overboard, the Nasdaq looks like is going to be more interesting to me to buy than the S&P 500 in terms of a trade during oversold conditions. And I forgot to mention on the S&P 500, another thing that makes the buy attractive is that these indices are trading well below their lower Bollinger Band, and the Bollinger Band are these black lines that define the range of expected price volatility. That's the plain English definition. And it's very rare, number one, for an index to trade, for sellers to be so strong to be able to keep an index below its lower Bollinger Band. So, so when we had this streak down here, that was pretty unique, even though it was interrupted by intermittent up days. So I expect the same here, which is some sort of automatic buying. We have a jobs report tomorrow morning, so that's a catalyst that could, of course, distort some of the technicals, but I don't expect the jobs report to be strong enough to divert the market from its technical destiny, so to speak. So this is extremely oversold with the NASDAQ falling down 6%. I mean, I just can't even believe I'm saying that. 6% in one day. And it's well below its lower Bollinger Band. Uh, AT50 is oversold. So this is a rubber band just waiting, just looking for an excuse to bounce back up. So QQQ, which will be the basically the closest equivalent to the NASDAQ that I want to trade, will be at the top of my shopping list tomorrow. And then we have the small caps, which have been sinking. An important thing happened today. It's down 6.4%. It's been following the NASDAQ a lot. And now it is below the bear market line, the conventional bear market line of 20% off the all-time high. That's pretty bad because I was such a bull. I followed Tom Lee, of all things, into the small caps last year. It was a great trade for as long as it lasted, and now it's completely fallen apart. IWM is not only below the conventional bear market line, it is all the way back to January 2024. So I always buy call options on IWM on extreme down days. I did that again today. Again, per the advice or the trading strategy that I outlined in my last video and on my blog, I did not buy a call outright. I bought a spread. That's to reduce the amount of premium that I'm paying for volatility. And now that IWM is below this important line and it's testing this resistance, I actually am not I'm going to leave IWM alone from this point on because there's a wide range between here and the pre-pandemic high, which is the next presumed support. And also I would prefer to get bullish actually on IWM whenever it gets back above this line. So that's when I'm really going to be most interested again in the small caps. Until then, I think IWM small caps are a huge landmine in this environment, and I just don't want to speculate there. Give me my big cap tech stocks until they completely fall apart, I guess, is what I'm saying. Anyway, that's I did want to show in one individual stock. I showed this yesterday, which was Apple. It was so tempting to buy Apple today. I mean, I just can't believe a big stock like this, a big market favorite, could fall 9.3% in a day. But then I looked at history. I looked back and I said, this 9.3% drop hasn't even taken Apple to a new 52-week high. It's just back to where it was after the rally from last year's WDC. So this means psychologically, sentimental, in sentiment or whatever you want to say, Apple actually could fall a lot further from here. Yes, this is a very extreme move, but I don't want to touch Apple until I see some sort of support, or some sort of basing or something like that. And who knows whether that will come soon enough for my interests. So that's all I have for today. Um, you know, there's lots of advice already out there listing out all the stocks that get hurt by tariffs and that don't get hurt by tariffs. Don't chase the stocks that are supposedly tariff resistant. It's kind of too late to be chasing those stocks, particularly if you want to be of the mindset that you're looking through the tariff noise in your long-term portfolio. Then what you really should be looking at is, okay, is my long-term portfolio properly pruned for the risk that I understand? And then what in my long-term portfolio do I want to buy more of now that it's on discount, rather than moving your precious cash into chasing the next set of winners. Now that could work for a short time, and if you're very nimble, have at it. But that's just not the strategy that I'm going to follow. So again, if you have questions or comments, put them down below the video. Share and like this content. That helps others find it. It also helps the algo understand that this content is worthwhile. Subscribe to this channel. And like I said, you can also go to my blog for more details in written form, drduru.com/122. Thanks for checking this out. Stay safe out there. And again, let's be flexible. Let's be nimble. Let's brace ourselves and be very soberly minded going forward. Take care.